So let's say you go buy a short-term rental for $1 million. You've expensed everything in repairs and maintenance. My CPA said it's better that way. As long as it was under $2,500 per item, I can do that. And I'm like, but you can't get lending, can you? Let me tell you what the real law says.
If the loan officer would have asked them that question, and they would have had the knowledge, of course, about the product, they would have only had to have put down 10% and had a much lower interest rate.
That is incredibly valuable.
And people just can walk into these deals feeling more comfortable that they're able to keep more money in their back pocket.
Welcome to another episode of the Hidden Money Podcast. We are going to be bringing to you a short-term rental kind of package here. And today we are going to have an amazing guest because no matter where you're at in the short-term rental process, whether you're just kind of saying, I'm interested in buying a short-term rental, or you're already looking at homes, there's one very important aspect that everyone covers, and that's going to be financing and lending. And how do we creatively fund our short-term rental purchase and maximize our cash and our tax savings? That's what we're going to talk about today. So I'm just super excited for this episode.
It's like you kind of have to have money to be able to buy a short-term rental, or someone else's money, and it's hard to get it. You need it. As we grew in our practice with short-term rentals, clients were looking for inventive ways and different ways of lending. We went to lender after lender, and they all said, you can't have a 10% down loan on a short-term rental. And thankfully, we found this guy who we're really, really blessed to have, Jeff Chisum. I call him Mr. 10% down in the short-term rental world, but he does a lot more than that. You absolutely can, and it's legal, it's legit with the federal guidelines to buy a short-term rental 10% down, but there's a whole lot more to it than that. Jeff can help you get the property and get the lending, but we're going to talk about a whole bunch of important stuff regarding lending with short-term rentals. Jeff, please tell us about yourself.
Yeah, well, I appreciate the opportunity to be here and join you guys and be on the podcast, so thank you very much for that. But yeah, Jeff Chisum, I've been originating mortgages since 2008. And
that's the year you started?
Nice. Why not?
It's going to sound familiar to a lot of people, and yeah,
PTSD just flared up in half the audience.
Yeah, exactly. Well, I call myself a survivor, and I will say, getting started in the business around that time, learned a lot, persevered through a lot, but it was a tough time. So. Yeah, kind of fast forward, I started in consumer direct with some of the big banks, retail banks, and then decided I'd really like to go out and branch out on my own. So started self-sourcing my own business, and by 2008 had achieved top 1% loan originator in the US, maintained that ever since then. And then in 2020, we bought a lake house with the 10% down second home occupancy loan. And basically up to that point, you know, my primary business was helping people buy their primary homes, just like most loan officers. But probably 5 or 6 years prior to that, I received one of these industry bulletins and just happened to open it up and read it and thought it was kind of a game changer when it came to second home loans, in that they were changing these policies, and really come to find out it was to keep people out of the gray area where they felt like, oh, I shouldn't be renting it. I'm the only one that should occupy it. Mm-hmm. So Fannie and Freddie knew how people were utilizing these properties, and were changing their policy to keep people from feeling like they were in this gray area. So I used that to my benefit, bought my first lake house, and then through that, just found out that there was a lot of misinformation out there around the product, around the policy. And a lot of it was because people were talking to their guy. You know, they were going to go talk to their mortgage guy they use on their primary residence and just kind of explain the scenario. So, you know, I'm going to go buy a place and I'm going to go buy an investment property is how it usually goes. And as soon as they hear investment property, they automatically jump to, well, you need 20% down, 25% down, we'll put you in an investment property loan. And if they would have just asked a couple more questions it would have set them on a whole different road of lower down payment, lower interest rate. And that's simply, do you plan on occupying this property at some point during that first year? They're like, yeah, we plan to go to the beach as often as we possibly can.
Yeah.
And when we're not there, we plan on renting it out on a short-term, basis through Airbnb, Vrbo, whatever the case may be. So if the loan officer would have asked them that one question, and they would have had the knowledge, of course, about the product, then instead of putting down 20% and having a rate that was about 1% higher, they would have only had to have put down 10% and had a much lower interest rate. And the reason that I know that to be the case is I'm still having conversations 6 years later where people are still being told that same thing. So
Yeah, all mortgage officers or loan originators, they're not created equal. It's very similar to CPAs, right? And tax strategists versus tax preparers. We see that all the time in our business. I kind of think, and this is why I think I get along so well with you, is you're kind of like in our groove in what we do for our clients. You look and understand the rules and help apply those rules to the benefit of your clients versus trying to just fit one size fits all, right? And understand it. And yeah, I mean, a lot of, let's face it, just like a lot of tax preparers, a lot of loan originators, they just know how to fill in boxes on a spreadsheet and they don't think. So we're excited about that. Now let me just point out what you just said and how that is incredibly valuable in tax planning. So let's say you go buy a short-term rental for $1 million, because I can do the math in my head. Doesn't have to be $1 million, but I can do $1 million in my head, I think. Kevin's going to check me.
We'll see.
We'll see. You buy a house for $1 million. If you have to put 25% down or 20% down, 200 grand, and that property is making cash flow in like $60,000 a year, right? That's $60,000 you're cash flowing each year. Out of the 200 that came out of your pocket, that's a 30% cash on cash return. But if you only have to put $100,000 down, that's a 60% cash on cash. You double your cash on cash return. That's one thing. But then when you put $100,000 down, you buy $1 million property, and you're material participant, you qualify for the short-term loophole. Don't worry, we'll get there with other episodes. If you can do that, that $100,000 just gave you somewhere between $250,000 or $350,000 deduction if you just do a cost seg. Or if you do a purchase price allocation, you can't always do it, but we'll get to that again in a different episode. Now you're saving $700,000 of a deduction, not taxes, but it reduces your income by more cash flow that comes out. So for people that are in the 37% federal tax bracket, now that we have 100% bonus depreciation back, your 10% down can actually be less than you get in tax savings. You can get a bigger refund that covers your 10% down.
You get paid to buy real estate.
Yes.
Because that's the whole thing with tax is I don't care if you put 50% down on this is a tax play, but if you put 50% down or if you put 10% down, your tax savings are exactly the same. It doesn't matter how much in cash you put down versus how much you leverage. Now we want to be careful that we don't over leverage and wake up one day in millions of dollars of debt, but that's something you got to manage your own personal finances with.
Oh, no, I just want to point out, it's okay to have $1 million in debt, millions of dollars in debt, as long as you have a lot more in equity. That's okay.
Yes,
That's
if
okay.
equity's going up and your cash flowing,
Yes, absolutely.
But whether you finance it or put cash down, you're depreciating the cost of the short-term rental or the property. So let's put as little cash as we can. So long, but we also have to walk through cash flow on a monthly basis and make sure, the less you put down, the more you're going to have to actually rent that property out to cover the mortgage, to cover taxes, expenses, and things like that. So
yeah, the numbers always have to work. The numbers always have to work, but what I've seen is the opportunity that's been created because of the 10% down is not as intimidating as a number.
It's a lower hurdle to jump over.
It's a lower point of entry. It's a smaller barrier, and people just can walk into these deals feeling more comfortable that they're able to keep more money in their back pocket. So, they're able to really be aggressive with setting up the property they want to, or maybe they're keeping it to do another one. But yeah, to go from this mindset of I need this with a 20% down payment to Now I've got something that is very comfortable for me. Really puts people in that position where they feel like they can take action, and ultimately, you know, it's good to see people have kind of an idea of what they want to do, but now they see that it's feasible. They're moving forward. So that's really been fun to see over the years, is just people taking action, because now they have this doorway they can walk through versus they feel like they're kind of stumbling, climbing up a mountain.
Yeah. And can you give us a little kind of example? Let's say someone bought the traditional investment property loan on $1 million property versus the 10% down. What is the rate differences in those two products, and what does the monthly payment differ on those two products? Generally speaking, and knowing that rates fluctuate, but
and credit and all that. But
yeah, so I'm not going to do the payment math in my head, but I will tell you. I will tell you from an interest rate standpoint, you're going to see a difference in at least 1% in the interest rate,
least, yeah.
And then the fees that you're going to have to pay, because it's an investment property, are going to be significantly higher. So you're going to pay probably on a deal today anywhere from 2 to 3 points to lock in the interest rate, just because they're going to tag on these loan level pricing adjusters because it's an investment property. Wow. So it's significant from that standpoint. But yeah, I'm not going to do the PITI payment on the cuff. Yeah,
I've seen you do it before. You just don't want to do it because we have video rolling.
Right.
and we have to hold you to it.
Yeah, that's exactly right. It's recorded. Yeah.
Someone's going to actually be at a computer doing the math and be like, this guy, no.
Yeah, exactly.
I want to follow up though on what you were saying about how having that smaller down payment really opens up and just opens up this opportunity for a lot more people. You and I, we all have shared multiple clients, a lot of clients that have been very trigger shy about pulling the trigger on their first property. And they came out with the 10% down. And with the 100% bonus depreciation back in the day, and now it's back and here to stay, Lord willing, at least for the time being, people were able to go and put this down. They were nervous, and then they got the property up and running with you. And they came to us, and we did their taxes, and they